Welcome to CEO Money. I'm Michael Yorba. Thanks for joining us. I have Stephan Little, Zero Limits Ventures, on the show with me today. Stephan, welcome to the show.
Thank you very much. I appreciate being here.
Okay, I'm glad you're here. Now, most business owners don't have an exit strategy. Let's start with that. Give us some full-bodied background on you, and then dive into this exit strategy topic.
Okay. Well, I'll try to keep my story brief, but I started my first business when I was 13, sold it when I was 15 for about $200,000 or a little more, and that sort of got me started. I actually learned a lesson then that I probably couldn't have articulated then, but here, years later, I can look back and go, wow, I knew something about value drivers then. What I discovered was that I'd built a lawn care company. I started out cutting grass like every other teenager, and one thing led to another. I was hiring other people, arbitraging the fees and so on. Ultimately, got to a point where I didn't want to resell every job every week. I was on my bicycle, I'd ride through the neighborhood, and Mrs. Smith, cut your grass this week. Well, August in Pennsylvania, grass doesn't grow very fast. So I started to hear people say, well, yeah, give it another week. Come back next week, right? And I started to realize this is going to cost me some money if I don't change this. So I came up with the idea of issuing annual and semi-annual contracts where they'd pay a flat monthly fee. I'd do their grass in the summer. I'd rake the leaves in the winter. I'd pick up the sticks after a storm. I'd just keep the place looking nice. No heavy-duty landscaping, just keep it looking nice, right?
Yeah.
And everybody went for that. And after, year and a half or so, I had a whole book full of these contracts. And when my dad came home to tell me we were transferring, I said, well, what am I going to do with my business? He said, well, I don't know. What do you just tell all these people you can't help them anymore? I said, no, I got to do better than that.
Yeah. No.
So I ended up selling it to what then was an upstart that's now become Lawn Doctor and, some of those. But it was an interesting experience. And the key to that story and the reason I spent the time on it is because what I learned was that the value of my business was in that book of contracts. And I had nothing to do with the people, the equipment, none of that. It was the contracts, and that's what the guy bought. So I carried that on over the years, and I've just always been in this part of the world where I build a business to sell it, position it for a high return exit, sell the business, move on to the next one. Did 6 of those on my own. All of them were pretty successful. Then I started working for top tier venture firms out in the Bay Area. Did it for them a bunch of times and made them a lot of money, and retired pretty young. Raised a couple kids. They went to school, got married, and left. I got bored and started Zero Limits Ventures. Right? So what we do, as you know, is we invest our time in helping business owners understand where are the key value drivers in your business and how do you maximize the value of your business. Now, the way we determine that is by helping them develop an exit strategy. Because the value, most business owners, you ask them 2 questions. I ask them, what's your exit strategy? 99% of the time I hear one of 2 answers. We don't have one, which is honest, or we're going to grow it and someone's going to buy us, which is interesting, but not a strategy, right?
Right.
So then I ask them, well, what drives the value of your business? Fascinating. 100% of the time, the answer I get is a question. The question sounds like this. What do you mean? Like revenue and earnings? Is that what you mean? Gross margin? Like that. And it's like, well, look, those are really important factors, and they certainly are part of the valuation calculation. That's a fact. But if those were the things that determine value, explain Snapchat to me. Explain Zappos to me. You can't explain those businesses if that's the basis of value. So there has to be something else driving the value of your business, and you need to know what that is. So explaining to business owners that the way you determine what drives value is determine who would buy you and why would they buy you. Once you understand that, you'll understand, well, if I invest in this area, I'm growing the value of my business. Now, you can still invest in other areas, but knowing that you're investing in something that's not growing value is a worthwhile thing to know, right?
Absolutely.
So, that helps you build. What I like to tell people is, look, the exit strategy is not about the exit. It's about the strategy.
Right.
It's about understanding that, hey, if I position my business this way, it'll be worth more in the future. The other thing I say to business owners is, look, it doesn't matter how you cut it, there's going to be an exit. Whether you go public, sell it, or keel over dead at your desk, there's going to be an exit. And you want your business to be worth something when you exit, right?
Right.
And so, that's sort of my big mission. It started out as sort of an educational thing. When I came out of retirement, I was just doing some consulting here on my porch, pick up the phone, talk for an hour. Thanks very much. But one thing led to another, and people started coming back saying, hey, can you help us with this? Can you help us figure this out? I mean, we understand what you're teaching us, but can you help us do it? And it wasn't long before I found myself back in the M&A world, opening the business Zero Limits Ventures, and now we carry the process all the way through. We start with a business owner, help them find the key value drivers, help them understand how to leverage those value drivers into a higher value entity, and then when the time is right, help them position that business for acquisition. And we generally get 200 to 400% more for the businesses we represent that they would otherwise get.
That's a big number.
It's a huge number. We had one last year, 750% value gain. That's 7.5 times the money. That was a big deal.
What kind of companies do you work with? Give me a for instance.
All different kinds, really. Pretty broad spectrum. Recently we hit a trucking company, turned them into an energy logistics company, got about a 300% value gain out of that. We've done a number of really interesting Amazon sellers, fascinating businesses that have a bunch of really unique attributes that make them an interesting acquisition play. Did a couple of e-commerce companies recently, pretty fast growth, very high return on those. That 700% gain was an e-commerce company selling kitchen cabinets, actually, and publishing companies, energy companies. We have a client who's one of the largest CLECs in Canada, so we've sort of a broad spectrum. The things we stay away from are professional offices, law firms, doctors, dentists. Not really interested in that kind of business, but pretty much any other kind of business.
The byproduct of a clearly defined value growth strategy, the business owner builds a better quality business, delivers superior returns. That's what you do, but you've got to get in there and convince them that do you have a lot of pushback that they're not going at the right value strategy, or do most people just kind of roll over and go, oh, I get it?
Well, I wish it were that easy.
Right.
But like a lot of things, when you present the information in an educational platform, which is how I engage the market, right. They can conclude for themselves, and it's actually sort of interesting. I give a presentation a couple of times a year that covers, how the game has changed and how to understand how to boost the value of your business based on today's trends. And there's a couple of charts in there that are extremely eye-opening to the business owner. And one of them in particular, everybody laughs when we review this, is if I hit that chart and it comes up on the screen, there's an audible gasp in the room. Everybody goes, oh shit, excuse me, right? Because it sort of implies that they're too late, that they missed their window. Mm-hmm. Then the very next slide, of course, says, well, but don't despair. Here's how we fix this problem, because everybody has your problem, right? Because most business owners don't build their business with an exit strategy in mind. I mean, let's face it, when you start a business, you're worried about starting it, building it, growing it, keeping it alive, hiring the right people, getting the right customers. That's a big job. You don't think about what you're going to do in the end. Well, that creates a circumstance where most business owners end up waiting too long. There's a chart, for instance, where it sort of shows the value growth curve of the business. So it's not the growth of the business, it's the value growth. And that ultimately wanes off in a couple of years, 2.5 to 3.5 years. And typically that's when the business owners first start thinking about, hey, I wonder when I'm going to sell this thing. But because he's waning off, it's late, right? Because he can only ride the growth wave down from there. So what we teach people is, start out early with your value growth exit strategy so that you'll be able to see the value of my business is going to peak here. That's when I need to turn it loose.
That is very interesting to be able to calculate when the optimum time to sell. I mean, I've been trading since 1980, and that's always my thing. But I think it's a lot more difficult to be able to calculate that because of the variables in a business, the humans that you have to.
Well, that is one of the key areas that we focus a lot of attention. So when we do our initial assessment, we do a very deep dive on a business. So we don't just do a valuation and go to market.
Right.
We dig in very deep, get a lot of very detailed information, including an evaluation of key employees and that kind of thing. And one of the things that we're teaching our clients is that if you're the founder of a business, it's atypical for you to be the person that's going to take it from 25 to 100 million, right? And from 100 million to a $500 million. If somebody else is going to take it there, it's probably not you as the founder.
Right.
So what we're teaching the business owner is, look, the time frame where you're going to generate the greatest rate of return on your investment of time and money is this early window. It's about 3 years long, sometimes 4, but 2.5, 4, somewhere in there. So is that when all the money gets produced? Well, no, that business that you might sell today for 20 million might be worth 100 million 4 years from now. But if you're the guy running it, you would have diluted yourself down to a point where after 4 years worth of work, you would make the same money that you would have made if you sold it when it was 2 years old. So what we're trying to help people understand is move earlier, take the money off the table, leave a little equity in the company, and then when it grows to 100 million, then take the rest of it out. That second check is usually bigger than the first one.
Great spot to end. I know that we'll have you on the show again and again, bringing the wisdom out to the people that really need to hear this.
Awesome.
Stephan, thanks for being a guest on the show.
Happy to do it, man. I look forward to doing it again.
My pleasure, too. You've been watching CEO Money with Michael Yorba. Like us on Facebook, follow us on Twitter, and subscribe to our YouTube channel.